Hi, good afternoon, everyone. Welcome to the webinar on how the Israel-Iran war could affect global energy markets. My name's Alistair Veer-Nicol. I'm the founder of Berkeley Energy, and I'm going to be the moderator of the discussion. The recent military escalation between Israel and Iran has reignited fears of a wider regional conflict, pushing the Middle East, particularly the Gulf, into renewed instability. Security risks are obviously evident, but we're going to discuss the longer term consequences on this for the energy markets, for pricing, and analyze the consequences of this, which are potentially much more consequential. We're having about half an hour's discussion. There'll then be time for Q&A afterwards, maybe 10 minutes or so. So please do send questions through to me on the chat if you can do through the discussion. And I'm going to now introduce you to the panel for today. We're really lucky to have an excellent panel, traders that have traded through various different political climates, including the first Gulf War, the second Gulf War, some of the effects of the ISIS incursions, the Libya and Syria bombings, obviously Ukraine and Russia, and now the current conflict. So they're well placed to analyze the potential consequences for the energy markets. Firstly, I'm going to introduce you to Gus Majid. Gus is the CEO and founder of Paratus, the world's first energy price risk insurer. Gus was a former partner of Vitol, and he was the co-founder, or the founder rather, of the global derivatives desk. Thanks, Gus. We then have Andy Harrison. Andy is a derivatives and energy trader, formerly with Goldman Sachs and with JP Morgan. And he is the global head of energy portfolio at Paratus. And last but not least, we have John Sfakianakis. He's director of risk management and head of strategy at Paratus. John has lived in the Middle East for more than 25 years. He has been a chief economist for various international banks. He began his career at the World Bank. We're pleased to say that John has just published a book, congratulations, John, on the future of the Saudi economy. And he's also been an advisor to various Middle Eastern governments on economic and fiscal policy. And again, is well placed to look at this from a geopolitical point of view. And so it's to John that I'm going to turn to first, please, just to give us an overview of the current conflict, what you see in terms of the possible escalation of it, its duration, and possibly to try and set it into context, if you can, in terms of its comparison to other recent conflicts. John. We may have lost John temporarily. And if we have, I'm going to ask Gus to give his overview while we get John back online.
Yeah, Al, great to be here. I think in the context of framing the market move and what's been happening prior to the dramatic escalation in this conflict, we were coming off a rather volatile period in the market where we were initially quite benign. We were starting to see economic headwinds globally, and then we had the somewhat unexpected Trump tariff moves. So that actually led to quite a significant downleg in the oil markets. Volatility spiked, and the pricing of a deceleration in the global economy. We saw significant volumes of shorts entering the market, and the oil market was moving down from high 70s on Brent to, we touched as low as $58 a barrel. So really, when the situation between Israel and Iran really started moving into fall, the market was really positioned very poorly, very short. And within a very short period of time, we moved very dramatically from $60 a barrel to the mid 70s. And the oil market's fear gauge, what we call the implied volatility, had settled post-Trump tariffs from 70s, 80% back down to a very, very low 20, 25%, 30%. And within the space of 5 days, we were back into the 60s to the 80% fear index levels, which are extremely high. The most recent high, we're back in Ukraine, where we're hitting 150, 200% for a very short period of time. So there is definitely more upside in terms of that. But not only that, we saw dramatic moves in given regionally, not only on the crude supply potential risk, but on the refining side, we saw very aggressive moves on the refined products. The products cracks refinery margins, but through that and the impact on the Fajari Jam gas facility, started seeing the market moving into implications for gas and by definition power. So in essence, there has been an immediate repricing and stabilization at these elevated levels. But going back and looking at history in these markets, Andy and I have traded these markets for 20 odd years. There remains still very, very significant tail risk that I fundamentally believe is still not priced in.
Thanks very much, Gus. John, can you hear us there? Have we got you back?
Yeah, unfortunately I can. Yeah, I hope you can hear me. And I'm in the region, so I'm in the Middle East right now, so it's very difficult to have my camera on because of the bandwidth. But allow me to share my thoughts on what is happening and kind of way forward, if that's okay, Alistair.
Please do, John.
Thank you. Again, apologies for the camera. So number one, I believe that what we're seeing now is the collection of mainly US forces in the region that is accumulating the ability to have to exercise a deep attack into the nuclear facilities. Right now, the US forces is accumulating 3 aircraft carriers, and collectively they'll have the ability to strike within the next week or so, or the few days that are coming up. And we believe that the US is the only capable party to take out the nuclear facilities. Israel does not possess, as you have seen in the media, the right type of equipment in order to do that, both on the aerial side, but also on the land side. Going forward, the question, of course, is for how long will this go on? The possibility is that this is going to be more than just a few days. If the US decides not to join for any reason, I believe that there is enough consensus right now with the administration to exercise power and military involvement. And more so, we believe that this is going to happen over the next few days. After that, if Israel decides not to continue, the question comes to mind as to what happens to regime change, and this could complicate matters. Definitely, the intention is to have regime change. And if the matter is not dealt now, the international community will be faced with a lot of volatility. At least this is the consensus view within Israel and the important decision-making part of the administration. Going forward, there are concerns about the Straits of Hormuz. If the straits are blocked, the US will intervene. And that's why there is an aircraft carrier coming from Asia to deal with that concern. Certainly, that will push commodities upwards, and that will increase volatility. But we don't know by how much. The uncertainty will be even more so complicated because over the next few days, we will see a barrage of Iranian responses as they're running out of missiles and vehicles to transport the missiles. But besides the military aspect, which is one aspect, the political aspect is that If there is regime change, which seems to be the case, what the US and Israel is calling for, although it's more of a gradual approach, the issue will be who takes over. And as we have seen historically from regime change, um, um, historical examples, it's easy to change regimes, but it's difficult and it takes a very long time to have a stable state, institutions, and so forth. And that creates even more so instability and uncertainty, especially as right now there will be a focus not just on nuclear facilities, but also if you take the regime down, you need to take down energy installations, including oil installations. So an attack on Harj Island a couple of weeks ago was seen as an impossibility. Today, I think that is very likely, as we have seen already, South Pars, which produces natural gas, and it's the connecting reservoir with Qatar, has been attacked. There could be additional attacks as infrastructure will debilitate the regime. Hence, I will not be surprised that 1.7 million barrels could potentially be taken out, which complicates, of course, matters as capacity needs to be found from elsewhere, mainly Saudi Arabia, which leads the OPEC efforts, followed by the UAE and others. These are kind of the two things that I would like to cover for now, and I'll be very much looking forward to your questions. I'll pass it over to you, Alistair.
Yeah, thank you so much, John. Could I just ask you a supplementary question before coming back to some of the effects of this on energy price? One of them is, are you aware of any attacks within Iran on energy infrastructure itself, or any effect at the moment on or attacks on any shipping? That's number one. And then the other thing, I'd just like to ask a little bit about this strategy of regime change and what you feel, briefly, if you can, on whether that's possible without boots on the ground. Is that where this is heading, or might it head somewhere else? Thank you.
Yeah. So let me say the following about regime change. And of course, it's a situation where most people in the media, when you read, it's a gradual attempt to beef up the plans. The plans, of course, for Israel are very clear. They want to see regime change, and they want to see either the existing crown prince return back or some kind of a formation of a coalition government. Of course, it's too early to tell because the regime actually hasn't fallen. But the intention is that clearly there will be regime change of some sort. And even if the current regime goes back to the negotiating table, it is still the perception of most people who take the decision to go in that the regime has to fall. That's one. On the issue of facilities, we've seen that overnight there was an attack on Arak, which is a facility that produces nuclear water. And we have seen that that has taken place. We know that also energy producing facilities, especially electricity, have been hit south of Tehran, north of Tehran, and outside. The attempt is to again debilitate the regime within and without. There are plenty of people who are doing damage. And again, the intent is not just to tire the regime itself, but tire the population that offers support to the regime and everybody else in order to create this opposition. So the intention is not just to hit on the nuclear facilities, but also to hit on everything that produces energy, that then produces support to the regime. And then that leads to the collapse of the regime. Because remember, the Iranian economy is faced with huge unemployment, 50% at least inflation, massive circles of influence that benefit the elite, but then everybody else is kept outside. And that has gone on for a very long time. So there is a clear attempt now to bring that edifice down. Thank you.
Thank you, John, very much. So just at the beginning, John, which you missed, and for everyone else, Gus gave a helpful overview of the immediate impact on the energy markets, which has been to spike the oil prices from the sort of 60s through to the mid 70s up to 80-ish. But it seems to be contained at the moment. And I just want to come to Andy a little bit here before sort of going a little bit further on the theme of energy prices, which we'll do. I just want to understand how the other components affecting energy price, such as shipping, insurance premium, maybe charter costs and other things, have affected the current scenario or might affect it. And I just would like to say that in addition to Andy's experience, Andy, I think you found yourself in working in the marine shipping business in the beginning of your career, right at the start of the first Gulf War, not to date you too much. So perhaps you just give us a bit of background of what it's like to be in that shipping arena, but also then the effect on pricing.
Yeah, thanks, Alistair. Yeah, that's right. I actually was on tankers during the original Iran-Iraq war in the early 80s. Not a pleasant experience, dodging missiles. So it's quite understandable today how you can understand why some of the ship owners are withholding ships from coming into the Gulf at the moment, with the heightened tensions that are going on, and the same for some of the LNG carriers. We're seeing normally the additional war risk premiums that might be around 0.125% normally. We're seeing those edge up to 0.2, 0.4%. And I think, as Dr. John has said, with the heightened tensions, if this develops further, we'll probably see these potential for these to spike higher. During the Russia-Ukraine war in the Black Sea, we saw these premiums peak at about 1.5%. And just for a bit of context, on a VLCC, that would be about $1.35 million compared to a normal premium of about $112,000. So it's quite substantial. So these are costs that charterers will likely have to bear, adding on to costs that the refiners are seeing. As Gus mentioned before, we saw some short covering, 25% of managed money shorts covered into this, which led to the elevated prices. And I think just one thing to note, although the narrative before the conflict started was one of oversupply, the actual fundamental reality was a little bit different. We've already highlighted that US crude supply growth has been stagnating. And so supply growth has not been there in the amounts that people wanted. The IEA has been revising down that number. The additional barrels that the OPEC V8 have been putting on the market have been managed to be absorbed by extra demand during the Hajj festival and the power demand that we're seeing in summer, not just from Saudi, but places like Iraq, who have had electricity constraints via Iran. And additionally, on top of that, we've also seen sort of Chinese buying, some additional Chinese buying. They've been restocking at over 1 million barrels a day. So all of these elements have added to a market that wasn't quite as bad as people thought. And so when the conflict came around, we've seen this big short covering rally to where we are now, and the nervousness in the market around tanker freight rates and what is going to happen next.
That's great. Thank you very much. And what about charter costs of oil tankers? Has that changed at all, and will that affect the pricing?
Yeah, all if you think about the TD3 rate, which is AG to East, they've all increased substantially. As I said before, there's the anecdotal talk of some tankers being withheld back. If this situation does develop dramatically, then we're likely to see the likes of VLCCs pricing back into the TD20, TD25 market to look at Gulf Coast to Cont or West Africa to Asia. So all these freight rates are getting elevated. It's starting to level out at the moment, waiting for developments. But all the shipping rates have all gone up, even the clean rates as well.
And just lastly, Andy, on this, before I move on to another question, can you just tell us what Iran's own production is and how that might fall off in a conflict, and how that could affect things?
Sure. So Iran are exporting, it was around 1.5 million barrels a month. Recently, it's been elevated substantially to above 2 million barrels a month. 80 to 85% of that, so roughly like 1.55 million barrels a day, goes to China. They've got around 30 million barrels of oil in floating storage outside of the Gulf. And what we're seeing in the very, very immediate term is a reduction in tankers loading at the Carg Island terminal, because they obviously fear for what might happen there. So if that was disrupted, there's obviously potential for Iran to still send oil to China from the floating storage, but it will dramatically affect things because people will project forward that that supply is not going to be there.
Thank you so much. That's really helpful. So we've set some context and some background also in terms of the global supply, but just coming a bit more to Paratus, do we have a view, generally speaking, of where the conflict is headed, how long or short it will be, and therefore if we come in from there to, you know, what the market's pricing in, and do we think that that's fair?
And that's a really, really great question, Al. I think the best way to look at it is to look back at economic history in the oil market. One thing we know that generally history doesn't repeat, but it tends to rhyme. What we saw in Iraq in 91 or 2003, the Venezuelan coup in 2003-4, and in Libya during the Arab Spring 2015, 2016, is that whenever you have either a regime change or structural military conflict, you see a material decline in crude output. So just to put that in context, as Andy was saying, Iran produces around 3.3, 3.4 million barrels a day. There's roughly around 2.6 million barrels a day of refinery capacity. This is within a region that produces around 29 million barrels a day and has about 11.5 million barrels of refinery capacity. So when we start talking about choke points, about the Red Sea, about the Hormuz Straits, we're talking about material impact on the global economy, which should not be underestimated. So really, the way we look at it is this regime change? What type of regime change is it? And I think the West has learned in an incredibly expensive manner, whether in terms of human capital or financial capital, that these regime change, whether through, we saw in Iraq, in Libya, in Egypt, in Tunisia, Afghanistan, and the subsequent immigration issues over the last 10, 15 years, if you break it, you're going to have to own it. So then are we talking a 2003 Iraq with the ensuing chaos, or are we talking a 1991 Iraq? I'm personally of the view that it's more akin to 1991, which is a significant decapitation, a massive degradation in the capabilities of Iran, setting them back many years, or even decades, and of containment. And I think this is potentially a strategic window for Israel and the US to completely nullify Iran's nuclear program. So I think in that context, it sets the stage. However, it does lend the question that, is the market correctly pricing the tail risk, given the regional side of it, and the volumes of crude oil, the volumes of refining capacity, and particularly gas, and the gas indexation into the global power markets.
Thanks. I'll come back to that, the comment on gas in a second, if I can, Gus. It's a very interesting one. I'd just like to bring John in. John, if you can still hear us here, because the length and duration of this, it just seems from what Gus is saying that this is going to be more protracted than perhaps the market is forecasting at the moment. He feels it looks a little bit more like the first Gulf War. Kind of what's your view on duration, of timing of disruption, and do you have any key messages to add?
Yeah, thank you. Let me add to what Gus said, that Iraq, Saddam Hussein fell in 2003. He was found in a bunker. The first invasion was in 1990, 1991 on the 16th of January. It took another invasion, well, 2003, to take down Saddam Hussein. So 2 invasions, land forces, massive infiltration, and a huge cost. And we haven't spoken about the cost. I'll give you just a hint. The Pakistan-India war, the 4-day war, cost India $16 billion and $4 billion for Pakistan. So that was a $20 billion war. It's costing a huge amount of money on Israel. Iran, I think, extensionally doesn't care because it's vouching for its survival. So basically, it takes a long time to take out a regime. And to build another regime, it takes an even longer time. And it's not going to be an easy situation. Yes, the 4-day, 5-day war we've seen already has been in favor of Israel because Israel has been planning for this for a quite long time. This is not a 2 or 3 month campaign. It has taken more than 11 months. And the American side got to know about this about a week prior to the attacks. So this is a protracted campaign. If they decide not to attack the nuclear sites, if the US doesn't come in, Israel cannot undertake the destruction of the nuclear sites, even if it has one of the best commander units, even if it has a lot of people on the ground, from the intelligence services all the way to special forces. It does require the involvement and only the involvement of the US because it has the magic bombs. If they do not take out the nuclear facilities and the regime stays, this is going to be a very long, protracted war. And having said this, the market does not account for this instability because the market is comprised of fairly younger people who have not gone through the experience of all the wars that we have gone through, either sitting on a desk analyzing it or trading it or participating in it. So I think that this is going to be a protracted, unstable situation, and it's going to involve a lot of volatility and uncertainty going forward. Thank you.
Thanks so much, John. I think that's a very interesting point about the market experience of the traders. I don't know whether Andy and Gus, you've got a view of this, and just in terms of their horizon, perhaps not quite as long as yours. And I'm just interested in whether there's geopolitics being taken into account by those traders, or whether they're looking at kind of screen data and what the signals that they're getting is. And how would you be reacting to those signals versus what you've been doing on your careers?
Yeah, it's a very good point that John makes. I think you look at all the narratives that are flying around in the market at the moment on, social media, research reports, reports from, banks or whatever. Every single one of them is basically saying there is a small possibility that we see significant disruption in, say, the Iranian oil exporting ability, i.e. we don't see Cargo Island getting hit and we don't see Hormuz getting closed. I think as Gus has highlighted, this feels a lot different this time. The reaction normally for the market, and we've seen it in the last few years on numerous times, is generally you want to fade a war. Basically, prices spike, but then the conflict doesn't last very long. We've seen the Israelis go into Iran a few times before with missiles. We've seen Americans hit Syria, prices spike, and then it becomes a great selling opportunity. And that becomes almost like a self-fulfilling prophecy where people look at it and think, yes, basically I'm going to believe the oversupply narrative that is being promulgated for Q4, and I'm looking for an opportunity to reset shorts. I think the danger, as Dr. John has highlighted and Gus mentioned, this feels like something different that could be protracted. We're seeing the initial signs of things that might happen when we saw Iranian infrastructure hit, as John mentioned, Israeli infrastructure hit, where the Haifa refinery was at 20,000 barrels a day. And the knock-on effects of those, where we saw Egypt tendering for fuel oil, we're seeing people looking for, the Israelis looking for coal and fuel oil for power, diesel, people are looking at it for power, and that's only the very beginning. So I think the market is getting very complacent that this is going to turn into basically a small event, and then we go back and we sell the market, and the market goes back down, and we reach the equilibrium back in the 60s. If we do have, significant events, and we don't know what's going to happen, but I think the chances are more elevated than the market thinks. If we do have significant events, then the Q4 oversupply story or the equilibrium level is going to be a lot different from what we think today.
Just to add to Andy's points and also to Dr. John's, I think there does appear to be a dichotomy between what the market is perceiving as priced in. And as Andy has said, the markets in these war situations, the knee-jerk is essentially buy the rumor, sell the fact. But what we're seeing here is that the dichotomy is that there appears to be major military assets that have already pre-positioned. So anecdotally, the movements and deployments into Diego Garcia, the base in the Indian Ocean, indicate that massive investment, as Dr. John was saying, has been put in place with significant capital deployed. Also, what looked like an illogical move heading into an economic deceleration globally, with OPEC rescinding their supply cuts and increasing production, now looks incredibly logical that this is pre-positioned. The Saudis with Trump backing, presumably through the Abraham Accords, that this is all being coordinated. And if we put this all in the context that if Iran is producing 3.5 million barrels a day, exporting 1.5, and OPEC's spare capacity itself is at 3.5 million barrels a day now, after these cuts have been rescinded, the global oil market will now be operating on razor-thin margins. So any outages will have an incredibly exaggerated impact.
Right. Thanks very much, Gus. I want to return briefly to the LNG point that we made earlier, and then I'm going to come back and just ask for sort of a roundup with some implications and insights from this. But firstly, just on LNG, for those people that are listening that are, say, less interested in the maritime and aviation sectors on jet fuel or on crude, that are looking at European power prices or US power prices, for example, what kind of correlation might there be to LNG? How might the conflict affect LNG? And do we see the same thing happening for electricity prices as we potentially see for crude?
So I think the short answer is yes. If you look at LNG gas storage, it's around 54% full versus normally it'd be 66% at this time of year. So already there's nervousness about the fill rates as we approach winter. We've seen the front end of the market move up. LNG prices and power prices move up as well because of the nervousness of what if we get a cold winter again and where are we going to be stock-wise. If you look at LNG from Qatar and UAE, 85 million tons went through the Strait of Hormuz last year. So that's 20% of global demand. So it's enormous. If that gets affected or curtailed, LNG prices are going to roof. We've already seen nervousness amongst LNG tankers to enter into the Gulf, so freight costs are going to go up. So we could, there's potential there for gas prices to elevate even further from where they are now, which will have a knock-on impact on electricity prices going forward.
Thanks, Andy. I'm just going to invite anyone to send any Q&A. We've got about 5 minutes left. Before I come back to ask the overall implications, and I have just one question that's come in so far. I think I'm going to direct that to John. the market seems to have priced in, I suppose, the forward curves are going back down, say quite to normal, but this is being relatively short. The question is, Trump is notoriously, how would I say, eccentric. He changes his mind relatively often. I think he said in the FT this morning, I may do it, I may not do it, but it could be very big. Do you think there's anything in terms of the resolve of the US administration, John, that needs to be questioned?
I think there is enough evidence that point to the clear inclination of the US administration, the hawks, to attack and participate in this endeavor. The back and forth of President Trump, I think, is known for, but at the same time, he has given enough green lighting to the Israeli side and Netanyahu to go ahead. And it is impossible to be collecting such a huge force. Next week he decides to put them back to Asia. Indeed, all the hawks are on the go for an attack that will probably take some time this month. And given what the Israeli ambassador in the US said, there was a slip of the tongue. He did mention that there is going to be an event Thursday night, Friday, that will be even bigger than what the Beamers, the attack on the Hezbollah fighters was done a few months ago by Mossad agents. So I think that the market is complacent. I think that people are just taking this as a given. I think this is the biggest restructuring and reshaping of the Middle East. It started with October 7th and it continues. And this is a major event that the Middle East will not go back. And I do not expect that President Trump is going to back away from this. I think he has a tendency to confuse, but he's very clear on the orders I believe he has given. And that's why we have now 4 nuclear submarines, 3 major aircraft carriers, and the collection again of aircraft is the largest collection of aircraft fighter jets, bar the Russians and the Chinese. And this is not, they're not going to the region to have a holiday.
Thanks, John. I'm going to stop you there. Just got a couple minutes left. One question's come in. I think it's directed really at Paris's own insurance business here. It says, won't all this current geopolitical chaos cause insurance rates to increase? Therefore, won't it also make fuel risk insurance less competitive? Maybe just a comment on how this would affect it. And while I might add there, Andy, could you perhaps just add your closing thoughts on what if Brent goes to 110, 100, anywhere higher than where the market's pricing, and what kind of implications does that cause, Andy?
Yeah, I'll let Gus answer on the Paris thing. I think you know, I agree completely with John that at the moment the market is getting complacent. If you think back to what happened with Russia, Ukraine, we all saw the buildup of troops and everything, and yet the market, you know, it was only when it happened that the market looked back and went, of course, why didn't we see those signs? I think we're seeing a similar situation with the military buildup here. We're already seeing some effects where, you know, there's talk of jamming in the Gulf. So it's clear that something, you know, there's potential for, you know, prices to rise further if events transpose and we see, you know, a large-scale military action. If we go to 110, 120, we're likely to see the Saudis being pressurized, as John has already said, to add additional barrels. I don't think we'll see additional oil coming from Russia. I don't think they're capable of that at the moment. I don't think there may be potentially an SPR release, but don't forget we're at 400 million barrels when we were at 700 million barrels not long ago. So as Gus has already said, the headroom that we had is getting less and less. I think because the market is complacent, there's room for potential the market to spike if military action sort of, you know, increases significantly.
And
just to add to Andy's point, your first question with regards to insurance and reinsurance, Al, like anything, the key in these conflicts, military zones, or extreme natural disasters, what you tend to know is you want to have the ability to de-risk as a business owner, whether it's an airline, a shipping company, an energy consumer, or energy producer. And you're already seeing it anecdotally. I mean, as Andy mentioned, AG to China on VLCCs moved from $20,000 a day to $50,000 a day. The world scale rates are up 50% already to 70 points. The insurance rates on the underlying, not on the energy price, but the underlying asset themselves is 0.125%, and it's moved up to 0.2%. So the market has already moved on an asset liability basis. If you look at the oil market itself, just to give you an idea, and this has only been in the last week, and this is without an exaggerated tail event in the 120, 150. The October $90 calls a week ago were trading at 23 cents a barrel. They're currently $2.75. So automatically there has been a repricing. But the question is that the right level? What is the market pricing in, and what is it pricing out? And everything, obviously, we've discussed today, everything that Dr. John and Andy have mentioned. There is room, and there still remains a significant tail risk that we believe that has been missed, and clients should definitely keep well aware when they're looking at their strategies and their risk management solutions.
Alistair, can I ask a question? It's more of a comment, but I want to ask a question because Gus has made an important point, and him and I spoke about inventories, and we said that the market erroneously believes that inventories are rather high. Hence, they take the view that, well, we have plenty of oil, and that's fine. But I want Gus to comment on this because it's a very important point. Gus?
Yeah, so the way we, Andy and I, and having done this for quite a while, we actually don't look at inventories on an absolute basis. The real way to look at inventories is on a demand adjusted basis, on a day basis. So what are the global inventories divided by the demand per day, which runs around 105 million barrels a day. And when you look at it on that basis, the inventories are not unusually high. And you could see that anecdotally through very strong crude spreads. You look at the refinery margins, they've been backwardated, what we call the cracks, the difference between the product and the crude. They've been backwardated and still strong. And
yeah, still strong. I mean, jet cracks, gas oil cracks have moved at almost like $10 a barrel. So we're seeing that sort of move already. And, it's at high levels compared to what we've had recently in the last 12 months or so, but there's significant room for that to get more elevated as well.
Thank you. I think we're going to end this now in 1 minute's time. I'm just going to say to anyone that's interested, if they go to the Paratus website, there is a very good daily energy update that they can get. Just look at the contacts and you can subscribe for that if it's of interest. Just like to thank the panel very much for your time. Gus, have you got any closing remarks that you want to make, potentially for power generators who are looking at PPAs at the moment, anything like that? They might have been left out a little bit of this discussion. And then I'll bid you all goodbye and thank you.
Thank you, Al. And for everyone joining online, it's been a real pleasure. I think that the key learning for us and sharing our oil and energy market experience over the last 20-25 years is that the last 15 years of cat and mouse between the IAEA inspectors and the Iranian authorities indicate that this is not business as usual. There is a structural change, fundamental change, both strategically, militarily, and politically. And we feel fundamentally that the market is mispricing this. and clients should be well aware of the tail risk implications. That in the end, this becomes an existential position now for the theocracy in Iran. And what is the next step? Do they feel fundamentally that they're in a corner and that they move to quickly develop a bomb, or do they back off? I mean, obviously we're in quite a critical period, an important religious period of Ashura and the Muharram, in a holy period where for the Shiite community. So there's going to be elements of face saving. You've got to ask, is Khomeini willing to pull back, or does he have to keep a face save, which inadvertently creates a tipping point? So that again, it points all to the same thing: existential risks, tail risks, and being able to price that. And through the gas markets, through the LNG markets, where we had a cold winter, we had low stocks, where we really need decent fill rates, where we're seeing the spread between the summer winter and this move back up, all it's going to do is reduce the fill rates. And the last thing we want is a protracted military conflict over the next 3, 4, 5, 6 months, heading into winter at low rates, and then ultimately it will create severe pressures going into winter. So again, it goes back to the same thing: being able to look at the extreme moves, being able to price the extreme moves, and obviously reaching out to the Piranhas team, who are always there to help and support our clients. Thank you all very much.
Thank you so much. I'm going to exit the webinar now and thank all of the participants. Bye-bye.